City Day.
I read somewhere that there's 99 days between Memorial Day and Labor Day, and how critical it is to, I guess, make each day count.
Summer's
These are the days that go by the fastest.
Yes, yes, I agree.
If I don't make plans, it's gonna.
Sometimes plans make it go quicker also. Sometimes too many plans isn't always a good thing.
Let's give it one more minute.
Okay. 25 people.
Give it to 11:04.
Right.
All right, let's rock and roll. I see a lot of familiar faces from kind of all walks of our business, which is pretty exciting. Just a quick introduction. I'm Andrew Luftig. My partner Alan has joined us as well. We, of course, have a real estate firm where we specialize in both residential and commercial, purchase and sale, leasing. We also represent a lot of the major banks in town on the residential and commercial end. The past few years, we brought in a estate planning attorney, a trust department, or a team. Actually, most recently, they've been dealing a lot with international clients, which is a nice niche above and beyond the regular estate planning and the probate administration and landlord tenant as well. But today, of course, we're taking a deep dive into townhouse market, and we have Lisa Ginsburg joining us from First Republic Bank. Lisa has been in the industry for 25 years plus. She's been at First Republic since 2013, really specializing in the residential and commercial construction market, whether that's single family, multifamily, commercial projects, which we'll obviously dig into as well. In New York and throughout many other states as well. Prior to First Republic, she was with JP Morgan. She graduated previous to that from Brandeis and Columbia Business School. So very acclaimed banker. But I guess the interesting thing is, and for us, and I'll let Alan dig in a little bit as well. So we obviously represent lots and lots of buyers and sellers, and especially in the townhouse market. And that kind of transaction is definitely different than your average condo and co-op deal, especially since a lot of buyers want to do, construction, want some options with financing. And a lot of the major banks in town really don't have a menu of options. So First Republic, we found, and more specifically Lisa, this is her niche, really stands above and beyond most of the competition in providing, purchasers with, whether they're doing financing, after the fact or as part of the acquisition. Alan, you want to give a little background as well?
I think today's topic and today's panel is kind of neat, especially with the market where it looks like it's heading, right? Everyone's talking about inflation rising. We see cost of funds, right? Interest rates keep rising. So as that happens, it gets much more difficult to buy something and then expect that there'll be appreciation. And one of the ways that everyone agrees that you add value, you add equity, is by doing renovations. No doubt that that's the number one way in this tri-state area to add value and add equity. And part of the problem is structuring these deals, right? First, you have to buy the land, you have to take down a building, then you have to get permits for building, you've got to get involved with your foundation, and you have to build the project. And the whole while you have to get construction costs, right? Construction loans. At first, you might need an acquisition loan. So a lot of those mechanics become really difficult, and those that can kind of overcome this, right? You may want to buy a property that doesn't have a certificate of occupancy. Maybe it's an SRO, a single room occupancy CO, that needs a letter of no objection, and then you're going to move on to building and try to get a final CO. All of those things require structure. And I think one of the things we want to talk about today is how do you structure these deals, right? How do you go about acquiring the property and then ultimately selling it? So I think this panel will hopefully be able to give you a little insight into what is construction financing, how do you put together these deals? So I guess let's start with Lisa. Tell us a little bit about what you do and what your role in the process is.
Thank you very much for the introduction and for including me today. I really appreciate the opportunity. So, at First Republic, I'm running a team. It's actually a fully integrated team that will work with clients from the moment that they identify a property, and they don't need to have plans, contractors, or specifications in order to provide them with a financing package that will enable them to acquire and build what they're seeking. And our team stays involved with the client and their project from the closing until completion, and that might be a certificate of occupancy. Many clients are holding the properties for their own primary or secondary residence, or other properties. Their other clients, their objective is to sell them. And so we're working to try to customize financing for clients who are in any part of the process. It also works for clients who already own properties. These could be for also ground up construction, or it could be for renovation. I know you guys mentioned Brownstones, which is definitely a big part of our business, but in the city, what's really interesting is that we also can do co-op condo gut renovations and combinations. So I know that the panel, the audience includes brokers, and much of the time you're selling units that are in state condition or really dated. And clients are going to have to spend hundreds of thousands or millions of dollars in order to get their dream home. And we can customize something that will enable them to take advantage of the construction product for those as well.
Do you see, like, for example, if you live in an apartment, let's say a co-op or condo in New York City, and you want to buy the unit next door, right? That happens every day. You own your apartment, you probably have a mortgage on it. Now, a mortgage or some type of UCC lien if it's a co-op. Now we want to buy the unit next door. How does that process work? How do I get the money to buy the place next door? And then I have to do renovations. So it seems, and then I have this first loan. So how do you put the whole thing together?
So in those scenarios, and that's a very common scenario where somebody's combining multiple units, although sometimes there are units that have some adjacencies that are being sold together. But what we're doing there is creating a refinance of the existing unit and providing somebody with both acquisition financing for the second unit, as well as financing that will be applicable to the construction. So what we do in these scenarios is, we're focused on A, closing the purchase, and then B, post-closing, we're going to get them ramped up for the construction. So the loans include an advance that will happen at close, just like a traditional home loan, but a portion is going to be reserved for post-closing when the client is ready to start building the home.
And how much, I guess, legwork, right, has to be done by the buyer as far as getting contractors, architects? What does the bank need in order to kind of get the loan going?
So initially for the closing, the clients really don't need to know anything except what an educated guess. I mean, they should be speaking to architects or a contractor to have some idea as to what this might entail. On a purchase, they should have at least a contractor or one or two walk through a property and just give them a rough estimate. And clients should add like a little bit of cushion, and we work with them in trying to come up with a cushion so that they have an estimated pro forma budget. That's all. That's all we need. Post closing, we're going to make sure that that we're going to do a check saying, if the client thought their budget was $1 million, are they online? Obviously, if they underestimate, they'll have to put in some extra equity because my loan at that point will be capped and it will not cover that increase. But we'll work with them in terms of trying to come up with a budget that seems to make sense, that they're comfortable with. Every once in a while, we have clients who will grossly underestimate the budget, in which case we have to refinance the construction loan that we put in place. So we have a client right now, we closed their loan in 2019. They thought it was going to cost them $1.7 million to renovate their East Village townhouse. Lo and behold, it's $3 million. So now they don't want to come out of pocket for that $1.3 million increase. So, in this case, client said, can you give me an extra $750,000? So we're, going to refi and give them an extra $750,000. So those scenarios happen as well.
That $750,000 will have to be put into the property. Will have to be construction costs. You'll give it out in installments, I would imagine.
Correct. So what happens ultimately in order to get the construction loan in that activation phase, the clients have to then have a contractor who, if we haven't worked with them, we could approve. They need to have plans and a budget, and we will need our appraiser to validate that if they're indeed spending an overall X dollars on the property, that the appraiser said, yes, if the work were completed and the home were on the market today, it would be worth at least X. And then we're collecting everybody's insurance and the permits. And at that point, we're ready to start funding the construction loan. And what happens in those cases is contractors will start making funding requisitions to their clients based upon work in place or deposits that are required. And then we involve what we call a third-party funds control company. They help us make sure that the contractor's request makes sense. They will send somebody physically to a property every month to make sure that the work that appears to be, that's been requisitioned appears reasonably to be in place. For anything but a co-op, we're doing monthly or at every draw, we're going to do a title continuation to make sure there are no liens. And we're also going to look carefully at all the paperwork the contractor provides. We want to make sure we know who's being paid. And then after they were paid, we want to make sure that we have some kind of proof of payment, because we want to make sure that the contractor just doesn't collect funds and then apply them to some other project or something else. So there is, a checks and balances there. And our clients generally like having all the checks and balance, because what protects us clearly protects them as well. And so every month, assuming the client's equity is all in, we will make subsequent advances from our remaining loan funds to cover the work that's been in place or the deposits that are required. But also the nice thing about a construction loan is clients are not paying interest on the funds they don't receive initially. They'll only start paying interest on those reserved dollars as they receive them. And there's no fee on any unused. So whenever they're ready for it, that's when they will receive them. And the other thing that's important to note is that we work with every client to come up with an appropriate time frame for their project. So we give clients time to identify contractors, get plans, a budget, and a permit. Somebody who's buying a townhouse in the city needs at least, 6 to 12 months and sometimes more of planning. So we have to build all that into the custom financing option we're providing them, because we need to make sure that we are realistically assessing what's going to be required. And then in the unusual case where somebody's not finished on time, then we'll have to work on giving them an extension to build, which if they're doing what they should be doing, and in all situations other than basically the client is having a dispute with the contractor and nobody's doing work, if everybody is doing what they should be doing, then typically we're able to give somebody an extension of that period.
We're going into an interesting time. I remember in 2008, I remember being in South Florida and seeing all these condos with cranes on the top where the work stopped. A lot of those construction loans in the commercial sector just stopped because there was no demand for the apartments. So what happened was, I guess, the amount that was owed on the loan was greater than the value of the property. So when we look into this residential townhouse co-op condo space, as rates rise, a lot of issues that we see clients that we represent are where contractors get paid advance monies, and next thing you know, the contractor disappears. It almost seems like the construction loan process is a good thing for the borrower, right? For the individual buying the property, doing the renovation, because you could almost use the bank as an excuse to say you can't fund the contractor too far ahead. So many people, I've seen so many clients where the contractor says, I need X dollars to start the project. And next thing you know, the project doesn't start, or they don't finish it the way you want it. We all know the finishing of a project is almost as important as putting down the foundation. And as soon as the contractor has more money than the work that needs to get done, a lot of times they disappear. So tell us about how like the parameters that get put in place, so which really will benefit the clients, I think, the borrowers.
Well, those are very valid points. And what we look at is trying to make sure that the contractor really doesn't have much more than a 10%, working capital need. And most of the time, those 10% has to be applied towards deposits a lot, especially nowadays, people have to put deposits very early for things like cabinetry, appliances, lighting and bathroom fixtures. Things are taking much longer in order to get their order done. But if every once in a while we're seeing contractors ask for more than a 10% deposit, and we're pretty much quick to tell clients, listen, that really exceeds industry standard. That seems to be a lot. Perhaps you can get them to cut back to 5 or 10%. And we explain to clients, again, the risks if they choose to give contractors a greater advance rates. And your example, Alan, about having cranes stopped. When we do the single family as well as the commercial or apartments and condos. When we looked at any condo, we look at them on a rental fallback basis. So we know that we can't always be sure where is the market going to be when the project is completed. So we say, okay, well, in the event that the condo expectations can't be there, what are the options for rental and the rental fallback? And so we've modeled that into our loan as well. The other thing we do is we're making sure that we've shored up all of the capital so that if there is funds that are remaining from the client to be spent before the bank gives the next tranche of financing, we require that equity in first, and then we fund the balance. So there's no pro rata, there's no, bank you fund, will fund later. We make sure that our loan is always in balance, meaning client's equity is always in, and whatever we have left in the loan always equals the balance to complete, so that we know every project that we get involved with should be able to be completed.
It will be interesting if values were to erode a little bit, the cost of funds, if interest rates rise, those numbers will get dicey. There's no doubt you need to have some capital in order to try to take advantage of what could be a price reduction market. Remember, when you talk about the A assets, they're going to hold their value in our city. I've been in the city with 9/11. I've seen Hurricane Sandy, and our A properties, our trophy properties, they keep their value. What we're talking about today is the peripheral area, apartments that need gut renovations, Brooklyn townhouses, New York City townhouses that might need a full rehab project. Those are the kind of things that are on the peripheral where there may be price reductions because traditional financing is very difficult to obtain. And there's only a few lenders in town that typically will structure that. A lot of times people will use bridge lenders or what they call hard money lenders. So I guess give us a little thought on that whole structuring part of it, because that's the toughest part.
Well, we're generally a conservative lender. So we're making sure that we build in cushion. The most that we lend on any project might be 70% of the total project costs or 70% LTV. It also, and we also have clients on building homes that are 40, 50, 60, and $70 million. For those, the loan is much more conservative. So we've built in cushion to withstand volatility. Plus also we're looking very carefully at our clients and underwriting them to make sure that they always have a liquidity cushion within them. And so that will also enable them to, withstand some dip of market. And, if it's somebody's primary or secondary, obviously they're looking to stay there long-term. It's not a near-term hold, so they can withstand a little bit of, short-term decline in property because they're not really selling it. For something that's investment, because we do have clients that we're working with, for example, in townhouses, and we just before this, I got off a loan committee. We have a client who just bought a townhouse on the Upper East Side, and they're planning to sell it. But we're not lending upon what the client thinks is their expected selling price. We're looking at realistically what might it sell for, and where are we comfortable on a loan to total project cost and loan to value.
Are there any types of properties that you stay away from? Any kind of scenarios that just don't fit the model, or generally speaking?
So, we do a lot of home lending, and I cover many markets. I cover the New York City market. I cover, Westchester, Fairfield, parts of South Florida, Massachusetts, Jackson, part of California. So we cover generally many markets, but there are, if you're in New York, if you're building in the Hamptons, it's not the same as if you're building somewhere else in upstate New York. So we're looking to see what is the client building, what is the liquidity of that home in that market, because it's very common for somebody to spend $10 million in the Hamptons. Upstate New York, it's not common for somebody to spend $10 million. So we have to figure out, okay, what are our options? Also, where will this appraise? And as we understand the market for that property, we're catering the loan and loan to value accordingly. So something, so the Hamptons is not treated the same thing as, upstate New York, or other parts of, northern Connecticut where we might lend for relationships. So we're assessing everything case by case, and these are all custom price, custom structured loans. So it's not a cookie cutter that applies to everything.
I think there'll be a lot of homes. I'm reading out east, the demand has slowed down a little bit in the Hamptons. And there may be some people that are in the middle of projects that walk away from them. And there's opportunities, hopefully, for some of our viewers to go out there and jump in midstream in construction and finish the project and sell the home. How would that structure work? Someone has a place, it's midstream being constructed, either ground up or a full renovation, and someone out there wants to jump in there. How can they do that with financing?
And just adding to that, just to layer it in a little bit, if there isn't a C of O, right? Or maybe maybe it's an older project, maybe the prior contractor didn't really kind of button things up. There's open work permits, there's issues with the DOT.
The violations, yeah.
Is that a,
impediment?
So those are all good questions. Any of those instances, as long as my construction, generally speaking, as long as my construction loan has a path to cure those, it's okay that they don't have a CO. It's okay there are violations, because I know my client is going to gut renovate. And before I close out their project, they will have at least a TCO, and they will have cured all those violations. So that's okay. They can have no kitchen, no working kitchens, no working bathrooms. The client, if it's a brownstone, they could be buying something somebody already gutted. I have a client now in Long Island who is buying a partially completed home. That's not the first time that's happened either. The builder, I guess, is just running out of money or getting tired, and they're selling it. So we're giving somebody an opportunity, funding that will enable them to take advantage of the work that's been done in place, plus, a reserve that will enable them to borrow some more money as the remainder of the construction progresses. So again, many scenarios we can come up with a solution in order to enable them to fund.
And everybody, don't be shy. If you have questions, we'd love to make this interactive. You can type them into the chat, or you can, I think you can unmute yourself, maybe not, but type them in the chat or raise your hand if you have questions.
While we're waiting, I'll share with you that as we have clients that are looking to buy properties, the initial conversations is really a broad guess. But we take the stress out of them, is they don't really need to have their final thoughts on their numbers until we get ready to finish their file. So if somebody comes to us and they say, oh, my build cost is $3 million, but as we move through the 60 to 90 day closing process, they learn that the cost is now $4 million. Well, as long as they, overall have the profile that could support greater debt, we have the ability to change the amount of the financing as we move along the process. So it takes a little bit of the stress out of the experience, and we give somebody a guidance when we pre-approve them that, yes, you have some leeway, or no, you're at the outer limits. Because we look at these loans traditionally like home loans from a debt to income standpoint, and we look at post-loan liquidity. And so we let people know where are they on the scale. do they have a lot more room or not? And so that also gives them that level of comfort to proceed.
What about timing? We always talk about as real estate professionals being proactive, but let's assume, a purchaser is looking at a property, finds a home or a townhouse, and, there's competition and they need to get a comfort level, right? Whether they can make this happen. In New York, we get an accepted offer. Usually you want to see a pre-approval before the offer is accepted. Sometimes I tell clients, listen, put your offer and get accepted. It takes a week or two to get into contract. If the bank needs some time to get things buttoned up and get you that comfort you're looking for. But obviously more time the better, but realistically, these days, how much time, again, generally, right, every deal is different. Do you need to analyze a deal and kind of give a client, maybe not, 100% guarantee, but I know with First Republic, once it's out there, it's pretty much buttoned up.
So most clients can be pre-approved within the week. Obviously, we have clients that have very complex financial statements and financial conditions, and it's sort of like peeling an onion. And as you learn more, you need to request more. But by and large, most people are pre-approved within the week. And the nice thing from First Republic, whether it's a construction loan or just a traditional home loan, when we pre-approve, we actually meet with a member or members of our loan committee, and we outline the client and the opportunity. So when we do send somebody a pre-approval letter, it's been, pretty much vetted by our credit team already. So they have that level of comfort of knowing that, we've taken the uncertainty out. So basically, they're really just, the only uncertainty is really an appraisal uncertainty, because as long as they've given us all the salient information and didn't omit anything, they know we're reliable from a closing standpoint. And then, we're trying to close our loans inside of, on a purchase inside of 60 days. If somebody has an extenuating circumstance, they'll need to check with us to make sure that we can accommodate their rush request. If we agree to accommodate somebody, we will make sure we jump through every hoop to make sure we deliver on that time. Because for what we do, we're relationship-based lenders. So unlike any of the other lenders, many other lenders, we're focused on the whole picture. So if the loan experience disappoints, that's going to impact the overall banking relationship. And we're looking at the loan as only at one part of this holistic relationship. We are hoping that clients over time, will grow their business, will refer us to friends and colleagues. And that's how the hallmark of First Republic Bank's success. So us being able to deliver, meet, and exceed expectations is part of the way that we work every day.
Can you talk about specs for the borrowers, DTI, credit score, reserves, et cetera, in general?
So in general, I would say, a DTI would usually be, not more than 40% in general. We're usually in general looking for post-loan liquidity that would be, about 25% of their hard costs plus a contingency. But there may be other things that are happening in that person's financial picture that might impact that. But the important thing you asked about specs, in order to close our construction loan, we do not need any specs. We don't need a contractor. We don't need plans. We will ultimately need those to fund the next part of the loan, but we don't need them to close. So hopefully I answered all the aspects of that question, and I'm trying to see it as well.
So this says, I have a client selling a townhouse. The interior was demolished. We have a potential buyer. Sounds like First Republic would finance such a project. What is your contact info, which I see is up top, Andrew put. What is the time frame for these loans, which I think we just discussed?
And by the way, this is where we're privileged to have Ms. Prado on this. This is an esteemed colleague in the attorney space. So thanks for joining us, Rosemary.
So yeah, exactly. I mean, this is definitely something we can do. Your client will have to have some general idea as to what it's going to cost them in order for them to fit into this mold, because we can't just give them a purchase loan, because we don't want to be sitting with a gutted building. We want to know there is a plan in order to get them to, a completed property. And it could be 1 unit, 2 units, 3, 4, 10 units. I mean, so we just have to understand what the plan is, and then we'll be able to structure something that will accommodate their objectives. But in that situation, your traditional home lenders are not going to be able to offer the client financing at all, because they're going to be looking for something that's a habitable structure, and that clearly is not. So somebody says, does a construction loan have to coincide with the home mortgage? So our construction loans, if it's a primary or secondary, it's like a home loan. It's a 30-year loan in term, and we are the only lien there. So if somebody has if this involves a property that's client owns where there's a current lien, what we would have to do is refinance that lien so that we can be in the first position, and then we can offer the remainder of the financing. And it is a 30-year loan. The product itself for a owner-occupied property, they're ARM products. So generally a 5-1 interest-only ARM, 7-1 or 10-1. So the nice thing on a 10-1, for example, the loan, they get a fixed rate and interest only for 10 years from closing. So it's a very nice feature. And then it puts the amortization or repayment in the client's hands for the first 10 years. If they don't want to amortize it, then they keep it interest only for that entire time period.
That makes sense. Right, I see this a lot, that someone said 2 couples looking at 2-family or 3 couples looking to purchase a 3-family. What is needed? Should they form an LLC? We see that a lot. I see a lot of a lot of couples will buy a 3-family, renovate 1 unit, move in, and then renovate the next 2 while they live there. And I've seen a lot of folks buy townhouses and convert them to condos, 2 or 3 unit townhouses. Talk a little bit about that, if that would be something you could entertain.
Well, right, we enable people to convert something to condo, and we also will provide release prices in the event that each one then wants to be able to, have their own unit and refinance them separately. But many times where people are looking to buy things together, and anything in an LLC is fine with us. So, and most of our clients do hold things in LLC. So we leave that to the client to decide. But if it's 2 families, then they could be applying, we're going to look at both of them in aggregate. They're both going to be the guarantors or borrowers of the loans collectively. Only when, if they ultimately are able to carve the property up, are they then going to be individually obligated on their loans from a takeout standpoint. But right now it's one piece of collateral. So, everybody would have to be on the loan, pretty much jointly.
Makes sense. I think that covers pretty much a good gamut of construction financing. Does anyone have any other questions? I think we've answered all the questions. Our contact info is attached.
Yeah, I'll cut and paste Lisa's contact info.
Yeah, I mean, many of you may have clients building in other markets. So, as I said, we have a lot of clients going to South Florida. That's next to the Hamptons, pretty much. That's our business market. We, for the most part, are from Jupiter to Miami, with some exception. And that seems to be, very popular with our clients today, as well as some of the other, popular second home destinations. So we do a lot in Nantucket. We're doing some in Discovery Community in Montana. We have many different locations that we might be able to work at. We have several in Deal, New Jersey, and then we have a lot in Greenwich, Connecticut, and other parts of Fairfield County. Very active parts of Westchester County, particularly Rye, Scarsdale, Chappaqua, and other parts. So you may have clients that would have an interest there. And the only thing we really didn't talk about is anything that's mixed use, because you may also have clients that are buying something that is mixed use. They may be retaining that mixed use configuration. They may be changing it to something that's all residential. So we, using our commercial platform, will work on providing that kind of financing to them. So there's a lot of avenues available, depending upon what the client objectives can be. Yeah.
So I think that wraps it up. definitely use this as a resource. Any questions come up, we're happy to help. Hope you enjoyed. Thank you, Lisa, for joining us. We've known Lisa for years, and she's always a huge asset to our clients. Enjoy the day.
Thank you very much for including me, and I encourage you to reach out if you have any questions.
All right, everyone. Have a great
Thanks,
day.
everybody.
Thank you. Bye-bye.
Bye.